episode 38 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
What we will cover on the podcast today is just a small part of what happened in the Special Situations world last week. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as our merger arbitrage tool, check out insidearbitrage.com. Please take a moment to like and subscribe to this podcast on whatever platform you might be listening on.
We are continuing with our new format by focusing on 4 key stories, including a deal between the 2 largest real estate brokerage companies, Anywhere Real Estate and Compass, a combination of stock buybacks and insider buying at the semiconductor company Marvell, the largest insider purchase ever, and Elliott's involvement with the enterprise software company Workday. Because we interviewed Evan Tindell for our podcast last week, we also have several updates related to special situations that have occurred over the last 2 weeks. Before we begin, we want to state that nothing on this podcast is meant as an investment advice, and please refer to our full disclaimer at the end of the podcast for more details.
Let's kick off this episode with M&A activity and a potential deal, or as we like to call them, deals in the works. The big potential deal that came out last Friday was that of Electronic Arts, which is supposed to be getting close to striking a deal with Silver Lake, Saudi Arabia's public investment fund, and Jared Kushner's investment firm to go private in a roughly $50 billion deal. This news came out last Friday in a story that was broken by Lauren Thomas and other Wall Street Journal journalists, and it has been amazing to see Lauren break potential deal after deal over the last several months. Considering this is coming from her, there is a high probability of a confirmed deal that might happen in the next few days. The news came out about an hour and a half before the market closed on Friday, and EA's stock jumped up 50% in response.
I mean, I'm a pretty big fan of The Sims, which is one of EA's longest running franchises.
Yeah, and other popular EA games include Battlefield and a bunch of sporting games that previously included FIFA Soccer before the agreement between FIFA and EA ended in 2023. The whole situation reminds me of Microsoft's acquisition of Activision Blizzard in a $69 billion deal that ran into a large number of regulatory hurdles, both in the US and the United Kingdom. The Activision deal was announced in January 2022 and took over 600 days to complete, which is a far cry from the 90 to 120 days most deals take to close. I was long Activision for the arbitrage spread for a period of time, and it worked out well even though I did not stay in the trade all the way to the close. Warren Buffett stepped in for a bit as well, but decided to exit relatively quickly as he assessed the regulatory landscape and realized that this was going to be much harder than most other deals he probably has participated in the past. Considering the EA transaction is a go private situation, companies like Sony should not be worried about the availability of EA games on the PlayStation like they were concerned about when Microsoft wanted to acquire Activision, and they felt like it is possible that Microsoft might only release new Activision games on the Xbox console. Let us see what the final price may be, but considering EA's stock is up 46% over the last 5 years, including the run-up on Friday, the final acquisition price could actually be a little higher than the $193 and change the stock closed at last Friday.
Moving on to current deal updates, it's been an interesting 2 weeks, especially as we've seen a lot of stories come to a close, starting with the Dallas News deal frenzy. The acquisition of this microcap news and entertainment business is one that we've covered repeatedly on this podcast, with M&G coming in with higher and higher competing bids. Just to recap, the original offer from Hearst was for $14 per share, and then M&G came in with a $16.50 offer, a $17.50 offer, and an $18.50 offer, all of which were promptly rejected. Last we discussed, Hearst had bumped the deal price up to $15 per share, and yet the stock still traded at $14.90, so there was still a tiny spread to be picked up. About 2 weeks ago, Hearst sweetened the deal once more by bumping the deal price up to $16.50 per share, especially after Gabelli Funds, who owned about a 2.7% stake in the business, disclosed the posing pill provision that Dallas News had adopted in July was done without shareholder approval. And furthermore, Gabelli was still unsure on whether or not to vote for the deal. The deal price bump did nothing to deter M&G, who came back with a whopping $20 per share offer. But Gabelli ended up supporting Hearst's updated offer, and a few days later, the deal got shareholder approval. The acquisition closed on September 24th, and it's a good case study on just how volatile microcap deals can be, and also how merger arb investors can profit from bidding wars.
Indeed. A couple of weeks ago, we also discussed Blackstone's acquisition of TaskUs, a digital outsourcing services provider. Blackstone is partnering with the company's co-founders to take the company private in a $1.62 billion all-cash deal, which works out to about $16.50 per share. I remember discussing the Dallas News deal with a bunch of friends in the Bay Area during an ideas dinner, and people were quite amused that it was only a $75 million deal at that point. So the TaskUs deal is almost 20 times bigger than that. TaskUs stock was trading 5% above the acquisition price when we last discussed it, and this is highly unusual when it comes to mergers and acquisition. The stock has appreciated even more now and trades at about $17.81, creating a negative spread of over 7% on the $16.50 deal. So why exactly is this trading well above the deal price? The minority shareholders of the company have come out quite vocally against the acquisition, which they think undervalued the company, and they floated fair value ranges between $19 per share to $25 per share. Interestingly enough, Institutional Shareholder Services, or ISS as is more commonly known, sided with the shareholders and urged them to vote against the deal. This might explain why the special meeting of shareholders was not pushed out once but twice to September 24th and then to October 8th. Seeing these actions, I decided to start a position in TaskUs as I figured my downside was probably $1 and the upside was probably $2 with a 60% probability that shareholders will manage to get a higher price.
And just to compare and contrast the two deals, I'm reminded that ISS actually encouraged shareholders to vote for that lower Hearst offer. So the fact that they are taking a stand against the TaskUs deal says a lot about the potential upside for the business.
Absolutely, and that's what convinced me to take a position in the company.
Exactly. Going back to bidding wars and another story that somewhat came to a close, another business that we've been following for quite some time on the podcast was a deal between the massive French food company Danone and the small dairy products company Lifeway, best known for producing kefir. Earlier episodes dive a lot further into the deal with all its twists and turns, but to briefly summarize, Danone had made an offer for $25 in cash for Lifeway, which Lifeway, led by Julie Smolensky, the daughter of the company's founder, swiftly rejected. Julie's brother Edward and her mother Ludmila, who had been kicked out of the company a few years earlier but still owned a pretty considerable stake in the business, actually supported the Danone offer and did their best to oust Julie, claiming that the board and its CEO were entrenched. Danone had bumped the deal price up to $27 per share, and the company, which was trading at around $22 per share prior to the first rumor, ran up to highs of over $33 per share after a lot of back and forth between the two companies. Lawsuits were filed on both sides, including Lifeway trying to invalidate an agreement with Danone from 1999, calling it illegal in the state of Illinois. It looks like about a year later, the brain damage didn't end up being worth it for Danone, and they backed out of the potential deal and withdrew their offer. However, the company said that it would consider using its voting stake in Lifeway in favor of Edward Smolensky's proposals to replace the entire Lifeway board, but it has not made a final decision in that regard.
So this takeover and family saga might not have reached its final conclusion, but certainly investors are disappointed. I'm surprised the stock ran up all the way up to $33 per share. Anyone who got in early in the process probably still has made money because the stock is now trading a little over $26 per share. But it's just been fascinating to watch the story unfold. Switching over to announced M&A activity, last week was very strong with 8 new deals announced worth nearly $21 billion. While we can't cover all 8 deals on this podcast, we wanted to briefly touch upon the largest one, which was the all stock acquisition of Anywhere Real Estate by Compass for a closing value of $7.08 billion. Anywhere and Compass are both real estate brokerage companies, and while the name Anywhere Real Estate might not be all that familiar to investors, their brands like Century 21, Coldwell Banker, and Sotheby's International Realty are quite commonly known. Compass and Anywhere were the first and the second largest brokerages by volume in 2024. Compass has around 40,000 agents, while Anywhere has about 51,000 agents at its own brokerage and another 250,000 through its franchises. While this might appear to be massive, the combined company's brokers will represent less than a quarter of US home sales because the real estate brokerage industry remains highly fragmented.
Does the highly fragmented nature of the industry mean consolidation will be easier? And if so, why is the spread on the deal so large?
Consolidation is likely to continue in the industry, but I feel like regulatory approval might not be as straightforward. And this is reflected both in the 9.35% spread on the deal and the fact that the companies are guiding to close in the second half of 2026. As we mentioned earlier, deals take anywhere from 90 to 120 days to close. And so when we see long deal timelines, that's basically a signal to the market the companies expect regulatory approval to take a long time. While Anywhere's market cap is just $1.17 billion, its enterprise value is $4.25 billion because of all the debt it has on its balance sheet, and is actually quite close to Compass's enterprise value of $4.81 billion. Anywhere was out on the prowl for an acquisition of its own earlier this year and was in talks to acquire the New York focused luxury brokerage firm Douglas Elliman, but those talks fell through. Compass has actually seen its stock decline by over 60% in the last 5 years, partially due to a big decline in existing home sales due to high mortgage rates, and partially on account of changes to the way buyers' agents are now compensated after a lawsuit that was filed. Overall, I think this deal will be good for Compass because if it can apply the technology and marketing strategies that it was using for its 40,000 brokers to an additional 300,000 agents, they should see significant efficiencies of scale. What's completely fascinating about the way Compass approaches marketing is that they have a three-pronged approach where the information about a new home is first released within its private network for price discovery. It then goes on to a coming soon stage to a larger group while the home is still being staged. In phase 3, the home goes live on all platforms, including the MLS and third party websites. This way, a home is less likely to see downward price revisions and long periods on the market when it hits the MLS. I'm generally not bullish on real estate brokerage companies, but this one is certainly interesting, and the deal offers an additional 9% discount on Compass in case you wanted to open a position and you want to do it through Anywhere Real Estate, assuming the deal finally closes.
While this deal seems to take quite some time to close, the deals that end up closing quicker are often biotech deals, and we saw two newly announced biotech deals that actually had quite a few similarities between them. That was the acquisition of 89bio by Roche for a closing value of $2.4 billion, and the acquisition of Metsera by Pfizer for a closing value of $4.9 billion. Both deals come with CVRs. Roche is acquiring all outstanding shares of 89bio common stock at a price of $14.50 per share and a non-tradable CVR of $6 per share in cash, while Pfizer is acquiring all outstanding shares of Metsera for $47.50 per share in cash, and then has a massive CVR that is worth about $22.5.
We tend to focus a lot on CVRs on Inside Arbitrage, and next week we're going to release an enhanced CVR database that looks back at 15 years worth of deals that had CVRs to see what the outcomes were for those contingent value rights based on specific milestones. So keeping that in mind, what are the specific milestones related to the CVRs for these two new deals by Roche and Pfizer?
Exactly. So they have to do with the drugs that the two companies are developing. 89bio is developing its leading drug, which is a therapy that mimics a natural protein in the body that helps regulate metabolism. It's meant to treat a condition known as MASH, and interestingly enough, just a few weeks ago, We spent some time in episode 33 discussing insider purchases at Madrigal Pharmaceuticals, the first company to receive US FDA approval to treat MASH. The CVR is based upon whether or not the drug will achieve net sales milestones of $3 billion and $4 billion by 2033 and 2035, respectively, and if the drug is first sold by 2030. The market seems somewhat optimistic about this CVR, and 89bio is currently trading at $14.70 per share, about 20 cents above the offer. As for Metsara, the biotech is focused on obesity and cardiometabolic diseases, with both oral and injectable candidates. The CVRs are not tied to sales milestones like for 89bio. Instead, they're based solely upon the launch of a phase 3 clinical trial for one of Metsara's candidates and then FDA approval for other candidates.
So that's fascinating. And you mentioned that one of them was trading a little bit above the deal price, and which is quite common because there's a certain level of probability investors are applying to these companies achieving these milestones and getting a payout. What do these acquisitions tell us about the biotech landscape? Is the whole biotech sector starting to come out of its nuclear winter that we saw earlier this year?
It could be. There's a couple different things to draw on here. Roche, in particular, has been acquiring companies to establish a position in obesity and metabolic diseases as a whole. This year, they secured development and commercialization rights for an obesity therapy from Denmark's Zealand Pharma in a deal worth up to $5.3 billion. In late 2023, it also agreed to acquire Carmot Therapeutics, another weight loss drug developer, with $2.7 billion paid upfront. Other weight loss drugs have generated strong interest from researchers and companies. In May, GSK agreed to buy a liver disease treatment from the biotech company Boston Pharmaceuticals in a deal worth up to $2 billion. And then Novo Nordisk and Eli Lilly are leaders in this fast-growing weight loss market with their GLP-1 drugs. And they are also testing these treatments for broader use against liver disease. We spent a lot of time on this podcast talking about biotech microcaps trading below the cash on their balance sheet and those types of biotechs getting acquired. But if obesity and metabolic diseases become the name of the biotech game, we might start to see further consolidation in that space, and the pharmaceutical giants might start snapping up smaller players, as we're seeing here, which would only contribute to getting us out of that biotech winter, as you just mentioned.
Absolutely.
Moving on to the spin-off section of this podcast, Bloomberg reported earlier this week that Genuine Parts, an automotive and industrial parts distributor, was considering a breakup between its two main business segments, with the auto parts business being a potential spin-off candidate. The automotive business, which generated about 63% of the company's sales last year, sells auto parts to repair and maintenance shops from more than 1 million customer locations around the world. The motion industries business, or the industrial segment, provides highly engineered parts and services to manufacturing and industrial industries, primarily in the United States.
I guess this is mostly at this point speculation, and no specific details have been disclosed just yet. So, what are you finding interesting about this business?
So the business actually made headlines earlier this month due to involvement from our favorite activist, Elliott, with the firm taking a $1 billion stake in the company, which had a market cap of around $19 billion and still does. Genuine Parts added 2 Elliott-backed directors to its board, yet another board shakeup at the business, which has had 5 newcomers join the board and 6 directors retire over the last 16 months. Elliott seems to be pushing to improve profitability at the business, which appears undervalued compared to its auto parts competitors like AutoZone and O'Reilly, and its industrial distribution companies and competitors such as Fastenal and Grainger. The spinoff could be Elliott-driven in a sense, in order to achieve this profitability and growth goal, especially considering Elliott's push for spinoffs at other larger companies like Honeywell and PepsiCo, 2 situations we've discussed on this podcast before.
I was exactly thinking of Honeywell and PepsiCo and Elliott's involvement as you were talking about that, because it seems to be the Elliott playbook, right? Get involved with this companies that have a core strong business and spin out the rest, if you will.
I mean, at the end of the day, it might actually be the GE playbook, because that's what Elliott always seems to point to as a success story.
Absolutely. Larry Culp laid out that playbook and showed how effective it could be. And I was thinking a little bit about the competitors that you talked about, AutoZone, O'Reilly, and Fastenal. These companies are wonderful businesses. So despite genuine parts splitting into two, the landscape is going to remain very competitive for them with these competitors who are extremely well capitalized and extremely good at what they do.
Exactly.
Switching gears to stock buybacks, one of the big buybacks that caught my eye last week was insurance company Genworth Financial, which announced a $350 million buyback, representing almost 10% of the company's market cap at announcement. The name Genworth Financial probably generates PTSD for a lot of merger arbitrage investors because it wasn't just the size of this buyback that caught my attention. It was also the fact that this company was the subject of the longest running acquisition saga I've seen in the last 15 years. In 2016, China Oceanwide Holdings made an offer to acquire Genworth for $5.43 per share in cash, and then started a process that went on for 4 full years. The deal quickly received antitrust approval, and the HSR waiting period was terminated early by the FTC. So that might have looked like things are heading in the right direction. Shareholder approval was also not an issue. However, the deal required approval by CFIUS, the committee that reviews cross-border transactions. The CFIUS review went on for the better part of 2 years, and the company extended its deal termination deadline through a waiver of the termination clause in the merger agreement. They went on to do 16 waivers over 4 years, and the deal
Wow.
needed approval from various state insurance regulators and even Canada. In fact, Canada forced them to basically sell a portion of their business to get their approval. In the end, some state regulators had to reapprove the acquisition because so much time had elapsed since their first approval of the acquisition. Genworth finally decided to call off the merger in April 2021, not because there were other regulatory approvals that were outstanding, but they had some concerns about China Oceanwide's ability to get the necessary financing to close the deal following the impact of the COVID-19 pandemic.
So, what was the impact of this failed merger at the end of the day?
I think they made the right decision to walk away after such a long period of time because it distracts from the core business. Companies with failed mergers often see their stock drop a lot when the merger is called off, and that could sometimes provide an investment opportunity because they could go on to do well downstream, while certain other companies like Spirit Airlines end up going bankrupt. Genworth is actually one of those success stories, and the stock is up 260% from the deal failure price of $3.51 to the current price of $9.11.
Moving on to yet another buyback, a company that we've been following closely for the past year or so is Marvell Technology, a designer, developer, and supplier of semiconductor solutions, specializing in data infrastructure technology. Our attention was first drawn to the company following a flip-flopping insider trade by the company's CEO, meaning he had sold and then bought shares within a 6-month period. And not only that, the flip-flopping transaction was his first purchase of the company since joining the business in 2016. At the time, Marvell's stock was trading at around $80 per share. By January 2025, we had seen this stock skyrocket to an all-time high of over $127 per share and believed we had missed the opportunity to add the company to our model portfolio. But this rapid rally didn't last for long. A few months later, the stock plummeted to lows of around $50 per share. In the midst of the drop, we revisited the company in our March 2025 newsletter. While we were a bit early with the timing, our thesis proved to be true. Marvell has rebounded quite well, up 34% in the last 6 months alone.
So, what's the thesis with Marvell? I know that its competitor, the bigger company Broadcom, is up almost double or 100% over the last year. So, what exactly is driving this optimism for both Broadcom and Marvell?
So, broadly speaking, there are two sides to the AI equation, and AI seems to be the driving factor between Marvell at the moment. There's a training process that consumes a ton of data and computing resources in the form of GPUs, very, very powerful ones, in order to create the models themselves. Now, if the models become commoditized, the opportunity for investors might be in inference. This is the part where the questions posed by users are run through lower end GPUs or custom designed chips. For example, Google has its Tensor Processing Unit, or TPU division. A TPU is an application-specific integrated circuit, or ASIC, developed by Google, specifically designed to accelerate machine learning workloads. Unlike GPUs, which were initially created for graphics processing and later adapted for AI tasks, TPUs were purpose-built from the ground up to handle AI-based computing tasks. One such company that enables these kind of ASIC chips is Marvell Technology. Benefiting from these industry trends, Marvell has posted incredible top and bottom line growth over the last few years and quarters. As a cherry on top, the company announced a $5 billion buyback earlier this week, representing 7% of the company's market cap at announcement. In addition, the company entered into an accelerated share repurchase agreement to repurchase $1 billion of common stock under the $5 billion authorization. To add to it all, this week we also saw 4 different insiders purchase shares of Marvell, and arguably they appear to be some of the most important members of the management team, such as the president of data centers, and data centers are one of the largest uses for semiconductors in this AI movement, the company's CFO, and the company's COO. And not only was it all of their first times purchasing shares of the business, but they were all also flip-floppers, having sold shares less than 6 months ago. Marvell's CEO also purchased $1 million of shares this week, marking his second ever purchase of the business. Marvell is very much a company that is driven by the AI craze, and if that bubble pops, the company will suffer. And the business also faces competition from its own customers, developing their own chips in-house. But if the ongoing issues with Microsoft's Azure Maya 200 chip are any indication, Marvell has quite a runway with its competitive moat.
Yeah, I was talking about Marvel with a few friends yesterday, and not only does Marvel face competition from Broadcom, but also from NVIDIA, if NVIDIA decides to use some of its lower powered chips for inference, and also because certain companies like Tesla are basically deprioritizing their own internal chip efforts, which could impact a company like Marvel. So something to really keep an eye out. You have this big tailwind of AI, but you also have the headwind of something like NVIDIA essentially capturing most of this market, if you will. Switching gears to insiders, earlier this month we saw a rare insider purchase at the semiconductor design software company Synopsys, which completed its acquisition of Ansys in July. So continuing on with this AI theme, Synopsys, obviously, as most people know, is a company that focuses on semiconductor design software, and it is a duopoly along with Cadence. While the purchase was by a director and it wasn't a very large purchase, it's the third insider purchase we've seen at the company in the last 15 years and follows a massive drop in the company's stock when it dropped from $604 to below $388 in a single day. The stock has since rebounded to almost $488. The big drop in the stock was on account of the company missing both the top and the bottom lines when reporting fiscal Q3 results, and the company guided to a weaker than expected fiscal Q4. The company is expecting to earn $2.78 per share at the midpoint of its fourth quarter guidance, but analysts had been expecting earnings of $4.50 per share. So that's a huge miss in guidance. Synopsys is still growing both revenue and earnings double digits in this red hot semiconductor market, but revenue in its design IP division did not grow as rapidly as they had expected.
Why do you think the insider bought shares now, even though they've been on the board for over 2 years at this point?
Clearly, the big drop in the stock price must have made it look more attractive. The Ansys acquisition probably hasn't been fully integrated yet, and you might see the impact of that acquisition downstream. And as I mentioned earlier, this is a duopoly along with Cadence. And if you remember, Warren Buffett used to love newspapers, especially in towns that had two competing newspapers that essentially got all the market share and the upside from being the duopoly in that town. And so when you think about the semiconductor software design space, really at the end of the day, it's either Cadence and Synopsys. Both companies are worth over $90 billion. And I think Synopsys could make a comeback, especially after this Ansys acquisition.
Absolutely. To round off our insider sections, we'll have to talk about the insider purchase that absolutely broke our scale 2 weeks ago. And that was the $1 billion insider purchase by none other than Elon Musk. It's funny because about 2 episodes ago, we spent some time talking about his massive $1 trillion pay package, and a few days later, We saw what is quite frankly the largest insider purchase we've ever seen. Since this purchase on September 12th, Tesla stock has already jumped by 13%, and a myriad of news articles have been released discussing the purchase and its possible meanings. This purchase actually marks Elon's first purchase of the company since February 2020, and the first significant transaction he has made since a series of sales in November 2022.
Do you think this purchase was particularly well timed?
That's the interesting thing. The purchase was very oddly timed, considering Tesla's recent and somewhat disappointing financial results. The company reported revenue of $22.5 billion, a 12% decrease year over year, driven largely by a 16% decrease in automobile revenues, which totaled $16.6 billion for the quarter. Operating margins also compressed slightly, ultimately leading to net income of $1.17 billion for the quarter, a 16% decline year over year.
You know, what's interesting is for the first time ever, I actually saw an ad for a Tesla. Very well
Huh.
laid out ad, and it made a pretty good case for why you should be considering buying the Model Y. How do you think about Tesla's place in the overall EV and car market at this point?
Maybe the advertising is needed in some sense because Tesla's facing a number of headwinds on that front. Total vehicle deliveries for the quarter declined 13% year over year, and the company's average selling price also declined. The specific numbers were not reported for that figure. Last month, Electrek reported that for the first time, the price of a used Tesla was lower than the price of the average used car. Chinese manufacturers have also gained significant ground when it comes to the EV space, with the Chinese automotive company BYD overtaking Tesla as the world's largest EV manufacturer, and BYD is also rapidly gaining market share in Europe, where Tesla seems to be declining. Now, living in the San Francisco Bay Area, and even times here in LA, you notice that nearly every other car is a Tesla Model 3, a Tesla Model X, or a Tesla Model Y. However, outside the bubble that is the Bay Area, or even California as a whole, Teslas are not that common, and the competition in the EV market has become fierce, even from other larger car manufacturers. At the end of the day, an investment in Tesla is a bet on Elon, and not necessarily a bet on it being a car company. And as we have seen with the company's volatile stock price, there are often opportunities on both the long side and the short side. We ourselves have been bullish and bearish on Tesla on numerous occasions, and we'll have to see how this continues to play out.
Yeah, it's interesting where Tesla exists right now at the intersection of autonomous driving, robotics, and a car company. It seems to have strong competition on all three fronts. You have Waymo on the autonomous driving front, there is Zoox by Amazon on that front. And then on robotics, obviously, there are existing companies like ABB and Google and Meta and everybody else focused on robotics. And finally, when it comes to EVs, it is a red ocean with competition on every front. Finally, switching over to activists, there have been two different developments when it comes to the activist firm Elliott. We've often joked in the past that this is like the Elliott Management podcast, and we were not disappointed to have more action on that front. They recently revealed that they now have a $2 billion position in the enterprise software company Workday. Workday, which was started by the ex-founders of PeopleSoft after Oracle swallowed PeopleSoft in a hostile acquisition, started out focusing on HR software and eventually expanded to other enterprise software verticals like financials and inventory management, which used to be the domain of Oracle and SAP. We've held a position in Workday for many years, and I've seen the usual trajectory of it starting as a high growth company and eventually settling into low double digit revenue growth. Earnings per share has been increasing as the company matures, and it now trades for about 7 times sales. I remember companies like Workday at one point trading at valuations of 30 times sales. Yes, sales, not earnings. Even 30 times
Wow.
earnings used to seem expensive, but that's 30 times sales. I was shocked when I first came across companies trading at over 30 times sales, and now Palantir trades at over 100 times sales.
Moving back to Workday for a second, what about the concerns that SaaS companies like Workday will be disrupted by AI native software companies that are building from the ground up?
Think some of that is going to happen. You will see AI native companies disrupt SaaS companies as a whole group. But as I've mentioned before, enterprise software companies that focus on the Fortune 500 will be very difficult to disrupt. At any rate, Workday is not waiting to find out, and they have been on an acquisition binge recently, picking up multiple companies focused on AI, including Evisort for AI review of contracts, Flowwise to build AI agents, Paradox for AI job candidate interactions, and Sana, their latest acquisition for AI learning. Elliott management appears to be happy with Workday's CEO Carl Eschenbach, who stepped in as co-CEO along with Workday's founder Anil Bhusri at the end of 2022 and then eventually became the sole CEO. Elliott mentioned that they liked his execution at VMware, where he served as the COO of the company after working for 14 years at VMware. And so this take Elliott has in Workday seems to be friendly at this point. I think some level of activist involvement is healthy for some of these companies, much like what we saw at Salesforce. The second Elliott company worth mentioning is their portfolio company Starbucks that poached CEO Brian Nichols from Chipotle last September. It takes a long time to turn around a behemoth like Starbucks, and we are yet to see Nichols' impact either in the stock price or the financial statements of Starbucks. The market hasn't particularly been pleased to hear that the company only plans to shut down 900 stores, representing 1% of their total stores. A turnaround requires bold, decisive action, and this is yet to happen with Starbucks. It'll be interesting to see if Elliott will remain patient or agitate for faster change at Starbucks.
Yeah, it's interesting because we were in Chicago last month, and I remember remarking that every single block almost had some sort of Starbucks store, and at some point they were all competing with each other, cannibalizing customers, because Starbucks is not operated under a franchise model like McDonald's. So to see more store shutdowns in locations like Chicago, where Starbucks seem aplenty, might have been a better decision, but it's interesting that change is taking quite some time to happen.
Yeah, maybe he'll eventually come to that conclusion and close down more stores after he transforms processes internally. So I think there is still a good chance we'll see a good outcome here, but it's going to take a few years for that to happen. Let's wrap things up by talking about C-suite transitions. Last month, both of us got a chance to talk to the management team of Postal Realty Trust, a REIT that focuses on leasing to the postal service and has occupancy rates of 99%, which is highly unusual with retail or office REITs. We have been following the company for some time now, following insider purchases by the CEO Andrew Spodek, often in the $13 range, when the yield on this REIT jumps to about 7%. CFO Robert Klein of Postal Realty Trust decided to leave the company in June after being with the company for over 4 years. The stock badly reacted to the sudden departure, and President Jeremy Garber stepped in as interim CFO. Last week, Postal Realty announced that Stephen Backey was stepping into the CFO role starting in November of this year. He was at the retail REIT Realty Income for nearly 3 years and at another retail REIT called Site Centers for 2 years before that. It was interesting to see that he was on the buy side for 8 years before switching over and taking corporate finance roles at Site Centers and then Realty Income. Among REITs, we find Postal Realty to be fascinating given its unique focus and look forward to seeing how Stephen will execute Andrew Spodek and Jeremy Garber's vision for the company.
And that wraps up episode 38 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you might be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.